So, you tap the food app on your phone because you want a burrito. You're hungry, tired, and you're entirely willing to pay a stranger $12 to carry your processed meat and cheese burrito across town. But before you can finalize the order, the app throws up a roadblock. It doesn't want to confirm your address. Nope, it wants to know if you'd like to apply for its branded credit card. It's offering you 2% cash back on future meals and priority access to customer support, which is a nice way of saying they will actually answer the phone when your driver inevitably takes off with your drink. Later, you open a rideshare app to go to the airport, and of course, it's going to ask if you want to open a high-yield checking account too. Then the next morning, you open a coffee app to buy a cold brew. This app is currently holding $3 billion in unredeemed customer deposits, technically making it one of the largest uninsured regional banks in the country. Your smartphone used to be a toolbox for the digital age. Now it's more like a reality show for wallet apps. 30 nearly identical contestants, all dressed up in different colors, elbowing each other and shouting, "Pick me! Let me babysit your cash!" It's less Swiss Army knife, more America's Next Top Wallet. This isn't a coincidence. It's the inescapable terminal stage of the modern tech economy. Every successful app on your phone is slowly, inevitably, and aggressively turning into a bank. Back in 2019, a partner at the venture capital firm Andreessen Horowitz stood on a stage and delivered a prophecy that sounded like a threat. She declared that every app will be a fintech company. At the time, it sounded like standard Silicon Valley exaggeration, right up there with colonizing Mars or replacing human interaction with a VR headset. But the prophecy is coming true. The tech industry looked at the heavily regulated, aggressively dull world of commercial banking and decided that was the ultimate endgame. So, how did we go from summoning a stranger with a thumb tap to gambling our rent money on instant microloans with the same reckless finger? It all comes down to the economic development of tech platforms. Awkward growth spurts, questionable decisions, and a relentless urge to monetize everything. The author Cory Doctorow coined a beautiful, highly accurate term for this process called Enshittification. It's a three-stage cycle of platform decay, and it explains why the app you downloaded to track your daily steps now wants your social security number. Stage 1 is the honeymoon phase. The app is incredibly good to its users, but operating at a massive, unsustainable loss, subsidizing your lifestyle with its venture capital money. You get $5 rides across the city, then you get free food delivery. The app burns through billions of dollars just to install itself permanently into your daily routine. You think you're getting a great deal, but you're actually just being trained. Stage 2 hits when the user is locked in, and the venture capitalists start clearing their throats, politely asking for a return on their investment. This is when the app starts to pivot. It stops being your digital best friend and starts being incredibly good to its business customers, catering to the advertisers, the restaurants, and the drivers. The app starts charging you more, but it temporarily subsidizes the suppliers to keep the ecosystem running. Your ride across town now costs $25, but the driver is getting a decent cut, and your food delivery fee triples, but the restaurant is getting prime placement on your home screen. Then comes Stage 3. The app has successfully locked in both the users and the suppliers. Nobody can leave because the switching costs are too high, and the competitors have all been bought out or starved to death. This is when the app turns the screws on everyone. They hike the prices for the users, then they slash the pay for the drivers. They also extort the restaurants with exorbitant fees, clawing all of that excess money back to the shareholders. The user experience degrades into a cluttered mess of pop-up ads and subscription tiers. The service is fundamentally broken, but it's highly profitable. This is the structural flaw in the Silicon Valley model. Highly profitable is not enough. Venture capital demands infinite, exponential growth. You can't just run a successful, profitable app empire. You have to conquer the known universe. But the real world is annoyingly stubborn. There's only so many Ubers you can take, burritos you can inhale, and coffees you can chug before your heart files a formal complaint and your doctor starts sending you passive-aggressive emails. When a tech company hits that ceiling, the stock price threatens to stagnate. So, they look for a new revenue stream that has zero physical friction, zero manufacturing costs, and infinite scalability. They start looking at the movement of money itself. Physically moving a human being in a sedan across Chicago costs gas, maintenance, and insurance. Moving numbers from one digital ledger to another costs absolutely nothing. Look at Starbucks. It realized years ago that selling hot bean water is a decent business, but acting as an unregulated financial institution is a brilliant one. They heavily pushed their mobile app and their gift cards. Right now, millions of people have 20 or 30 bucks sitting in their Starbucks accounts. Collectively, that represents billions of dollars in unspent capital. It's effectively a massive zero-interest loan from caffeine addicts to a multinational corporation. Starbucks can take that cash, invest it, and earn interest on it, while you get nothing but the promise of a future macchiato. They bypass the Federal Reserve entirely by creating a flat currency backed by roasted beans. The rideshare platforms followed the exact same playbook, but they aimed it at their workforce. First, they offered their drivers a branded debit card to get paid faster. It sounds like a convenience, but it's actually a trap. If your primary checking account is tied directly to your employer's app, your switching costs just skyrocketed. You can't easily jump to a rival driving app if doing so means disrupting your ability to buy groceries. Once the driver is locked into the financial platform, the app starts offering them cash advances and loans for car maintenance. The same tech overlord who decides your paycheck is also the one charging you interest, just to keep the hamster wheel spinning. It's basically a digital reboot of a 19th century company town scam, where miners got paid and then had to spend it at the boss's own overpriced store. Only now, you get push notifications and a balance that never quite adds up. You might be wondering how a food delivery app legally starts issuing credit cards without building a bank from scratch. Well, they don't actually build anything, they rent it. This entire mutation is fueled by something called banking as a service. Traditional, heavily regulated banks have essentially turned their core infrastructure into an API. They handle the messy legal compliance, the FDIC insurance, and the anti-money laundering protocols. Then the tech company slaps their sleek, minimalist logo on the front end, and boom, they're in the banking business. The tech app gets the high-margin revenue of a financial institution without having to hire a single bank teller or deal with a federal regulator. And given enough time, unfortunately, every hot new app ends up wearing the same corporate uniform. So, what about the thing it was actually built to do? Well, that gets shoved into the never-ending gig economy, while the banking business model quietly takes over the main stage. Major airlines figured this out a decade ago. An airline isn't really an airline anymore. It's a credit card rewards company that occasionally flies planes to justify its existence. The retail giant isn't a store, it's a digital wallet that occasionally ships you bulk paper towels. The rideshare app is a payday lender with a fleet of cars attached. They all want to issue you a card, hold your deposits, and track your transaction history so they can feed that data into a machine learning algorithm, then target you with hyper-specific advertisements for things you don't need. They're building a closed-loop economy where your money never actually leaves their platform. You earn it on their app, you store it in their wallet, and you spend it on their services. Remember the sales pitch? The tech revolution would transform the world into a perfectly tuned, algorithmic engine. Software would chew up inefficiency, spit out productivity, and leave us lounging in cafes while robots did the heavy lifting. So what did we actually get? The world's most powerful wealth engine, repackaged as the same old banking system, just with shinier buttons and a never-ending stream of notifications reminding you that, surprise, your money is still mostly theirs. Silicon Valley solved all the easy stuff, so now they've moved on to the real goldmine, turning your bank account into their next line item on their balance sheet. So just remember, when your favorite app pops up with a cheery request to update your terms of service and unlock a shiny new digital wallet, you're not unlocking a special feature, you're signing up to be their next product. Most apps have zero interest in helping you save money. And they've finally realized that your data is yesterday's news. Your attention span, which, let's be honest, is already being auctioned off to the highest bidder. It's the delicious friction between your paycheck and their bank account thereafter now. And trust me, they'll keep cranking out software updates until your money slides into their pockets faster than you can say automatic withdrawal.